afternoon and welcome to BizTech's Asian Midday Market Watch. It's Tuesday, the 5th of September, and we have as our guest today, Redmond Wong, market strategist from Saxo Markets, coming out to us from Hong Kong. Now, Redmond, it's always good to have you on the show.
Thank you, Brian. It's really good to see you come back to your show again.
Now, Redmond, for a start, we've had a lot of regulatory easing particularly in the property sector and banking sector in China. Could you give us an overview of some of the key points of easing and whether or not this will really move the needle in terms of renewed investor confidence in China?
Yeah, thanks for the question. Yes, and especially last week, well, the whole week last week, there's quite many things coming out from China, and much have to do with the property sector and also the banking sector. I think the most important thing is really the down payment requirement has been standardized, and by standardizing it, actually has been revised it down. And because in China you have so-called tier 1 city and tier 2 cities and also tier 3, tier 4, and usually those higher tier city with buying restriction, they are more stringent on the down payment requirement, and also they differentiate between what they call the first home buyer and the second home buyer. For first home buyer, you need to pay down payment of 20%. It's legislation-wise, but before that change in the regulation, and you actually need to pay a lot more, like 30-35%, or in Shenzhen you need to pay even higher. And so also from second home buyer, and they need to pay, in the past is down payment, they will need to put down some kind of 40%. Now they can put down to 30%, and also for some of the tier 1 city in the past, as like Shenzhen, as high as 70%. Now also all standardized to 30%. So, and that is that of course is that release some kind of buying power, and for people, especially for those people who can sell the existing home and then could move into buy a new home. So that is one thing. It's not a stimulus, but it's more like a relaxation of some regulation. And the other one is also quite significant. Is also the moving down the minimum mortgage interest rate for those second home buyer. In China, the mortgage interest rate is set by is benchmarked to the 5-year long prime rate. That is the 5-year long prime rate plus 60 basis point for second home buyer. But for first home buyer, it will be the long prime rate minus 20 basis point. So it's a big difference of 80 basis point between the two. And this time, the Chinese government is lower the minimum mortgage rate for second home buyer, and from the long prime rate plus 60 to plus 20. So that is actually a lowering by 40 basis points. So that again helping to reduce the cost of the home buyer. So all this is been kind of helpful to the property market, but helping more on the tier 1, tier 2 city. It's less so for tier 3, tier 4. And so overall would be as investors, when we look at the buying stock, better to find those property developers or property service company which have more exposure to the tier 1, tier 2 city like Beijing, Shanghai, and Guangzhou, and Shenzhen, and so on, and then to the lower tier city. So it won't help those developer focusing on the lower tier city. So we have to be divided on that. Yeah.
Okay, so here's the thing, Redmond. However, property buying is all about confidence and wealth effect. And the wealth effect for Chinese consumer has basically been negative because they feel poorer, their property values have stopped rising. In fact, they have fallen. Will these be enough, particularly with all the negativity around Evergrande, around Country Garden with the big headline numbers, but of course many other developers are in trouble? Will these new measures really bring out property buyers back into the market?
I think you say very right. It's actually really a confidence game for properties, and that help us to boost some kind of confidence, especially in the tier one, tier two city, because we seeing the government now is more, more, less restrictive on for those cities. But overall, yes, it helped, but it's not going to say it's not a game changer. Kind of, it's incremental. It helped, but it's not going to change things overnight. About the actually, you addressed a very good point. Exactly because of when Chinese household has lost confidence in the property market, and also, in fact, also some other investment opportunities has been not doing that good. Since these years, and we have a lot of prepayment. People pay down their mortgages before they expire, before they mature. So actually, Chinese household pay down something like 2.5 trillion RMB of mortgages for in the first half of the year. That actually hurting the bank's profitability. So that's actually why last week one of the measure within the bundle, we have not talked about it yet, is the PBOC actually urged those banks to lower the mortgage interest rate charges for the existing mortgage, because in China it's very interesting. Even though the mortgage interest rate is indexed to the benchmark, the long time rate, 5-year long time rate, but they only adjust every 1 year. So it's always
I
only adjusted
see.
on the 1st of January. So if the central bank cut interest rate for those mortgage borrower, those household, and they are sitting on existing mortgage, they won't benefit. They have to wait
Okay.
until the 1st of January. So, and of
Interesting.
course, that's good for the bank. I mean, the bank make more money, and but at the same time, so the household say, hey, wait a minute, the property market is not doing so well. We have a lot of money in the bank, and the deposit is coming down, and the stock market is not doing that well, and the wealth management product are not also seems quite shaky over this year. So why don't we just take the money to pay down our mortgage debt? So there's a lot of prepayment, and that is become an issue for the bank. And so that's also why the Chinese government, the PBOC, now work with the bank to lower the mortgage interest rates for the existing. So allow them to renegotiate, to adjust the mortgage, the interest rates even during the year. So
And
now
Redmond, that is a very interesting insight that many of us outside of China don't actually have are privy to in terms of information. That's quite interesting. But we also see, Redmond, this in the sea of all the bad news, there's also some good news now that we're starting to see perhaps a little bit of green shoots. The Caixin index PMI data showed encouraging improvements in August. Are you optimistic moving forward that perhaps the worst is over for China as an economy?
I would not say it's the worst is over, but so definitely. But I agree with your choice of word saying there's some green shoots. I think there is some encouraging sign, and cyclically we think that is maybe as we will be seeing some rebounds from here. And I mean, and very particular and encouraging is the new orders of components is also turning up and above 50 on the expansion territory. So the new order is doing okay, and the overall index is also doing good. The drag at the moment is still the export. Export is still not doing that well, still in contraction. But overall, yes, it's encouraging, and that helped, I think, to boost confidence. Again, I mean, it's investor has been really downbeat sentiment. I mean, for the month of August, if you look at the Stock Connect, overseas investors buying into Asia through the Stock Connect actually was a net outflow. Actually, it was the biggest net outflow. I think something about 90 billion RMB. This is the biggest one since the Stock Connect mechanism set up in 2014. That's the biggest monthly outflow. So offshore investors has been leaving the Asia market in August, but I mean, but so sentiment is not very good. So that this kind of small improvement can help to stabilize, I think. And actually, yesterday we see a quite good net inflow again into Asia from offshore investors. So I think helping the confidence a little bit, and then some of this better economic data because of the sentiments already so bad, and so that will at the margin should contribute and should actually help to stabilize the market, and positions very light. I mean, people, we will adjust if they just reduce some of the underweight, that would be some helpful. That would be quite helpful. Yeah.
Now, on that note, Redmond, thank you very much for your insights. Thank you for coming on the show.
Yeah, thank you, Brian. Thank you for having me.
I'm Brian Fernandez, and we've been speaking to Redmond Wong, market strategist from Saxo Markets, on BizTech's Asian Midday Market Watch. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.